Hi everyone. This week's episode we are calling it as three good news leading to a rally in equities, bonds and gold. The first good news was about a reopening of Chinese economy, that is relaxation of zero COVID policy. When China grows, the rest of the world also grows with it. And as a result, the Hong Kong equities have rallied by 15% in the last 15 days. The second good news was benign CPI print in the US, which and the core inflation coming in at 0.27% month on month was the biggest positive. Indian equities were mixed. Nifty went up by more than 1%, whereas mid and small cap indices ended in the red. And this happened because of a slight change in the rule of MSCI about inclusion of stocks in the bonds. And given the change in rules, it is now expected that HDFC Bank will get included in the index. And if you look at the gainers and losers of the week, we find HDFC Bank and HDFC Limited were up more than 6%. And but for these names, even Nifty would have ended in the red. The Indian equities are kind of clearly expensive, with the number of stocks at a P multiple of 50 or higher is at a record high. Now, what kind of earnings can sustain such P multiple is something that only future will tell. Now, could one have anticipated this kind of rally in equities, gold and bonds in the globe? There was one pointer. One is that when after the last FOMC meeting, the expected Fed fund futures rate went up to 5.2%. And however, the equities didn't sell off and didn't go to a new bottom. The bond yields did not go up to a record high, nor even the dollar index did not go up to the near-term record highs. That basically tells us is that the marginal seller was out of the market and the markets were clearly getting oversold, and negative news was no longer impacting markets the way they used to do earlier. This change in the scenario for interest rates will result in growth stocks doing better than value stocks going forward. Until the run up to the CPI print, the value stocks had best performance in 20 years. And this should reverse and growth stocks should rebound. When you look at the top 11 countries of the world, India incidentally is the 10th biggest country. We see that the story around India is fine, but the numbers don't seem to justify the kind of momentum that Indian equities are seeing. Or else, one can say that the positives are really priced in. This is because at the beginning of this year, the EPS growth for 22 was expected to be 24%. We are ending somewhere close to 14%. So in spite of the 10% cut to earnings for 22, the markets are at a record high. And one can be skeptical about the highest earnings growth that the world is expecting from India in 23 and 24. When recession happens, as it is expected in 23 and 24, the earnings get cut. In fact, typically there is a negative growth in earnings. Now, in that case, the ROEs will collapse. We are sitting at a time when the ROEs overall for the world is at a record high. And should recession set in and earnings get cut, the ROE will fall. And not the best time to be buying equities aggressively. Of course, performance in different countries will be different. When we have talked about, we have compared the 10-year GSEC yield with the earnings yield of equities and kind of concluded that bonds are a better place to be in than equities. But if you compare the earnings yield with that of the corporate bond yields, then the outcome or the conclusion is somewhat different, and equities don't appear so expensive. So why only look at G6 and come to a conclusion about equities? May as well look at corporate bonds also. One of the things that has held up well for India is the robust SIP flows, and October was no exception. Although flows into mutual funds may have slowed down, but the SIP flows are at a record high. Janet Yellen, the Treasury Secretary of US, was in India, and her words are encouraging for India's manufacturing sector, as she thinks that there will be a lot of countries who will be reluctant to be depending solely on countries like Russia and China, who have political risks around them. With India's performance, being the best in the world, a lot of global brokerage houses are now, taking notice, and Morgan Stanley was the recent one, which highlighted the robust expected GDP growth of this country, and therefore this is and saying that the next decade is going to be India's decade. The bonds rallied very hard during the last 2 days of the week. The US 10-year bond yields fell by 35 basis points. Indian 10-year GSEC yields fell by 15-16 basis points. And we know the reason, the benign CPI print. We would have expected the curve to steepen a little more, which didn't happen. Should happen in the coming days and weeks. And with no incremental news expected in the next 2-3 weeks, we expect the rally in bonds and equities to sustain at these levels, if not go up. Now, one benign CPI print and the Fed fund futures rate has come down from 5.2% to somewhere close to 4.8%. And so, if the inflation behaves well and keeps surprising positively, the peak US fund futures could be a lot lower. In India, for October, the CPI print is expected to be 6.9%. It was yesterday that RBI governor was at a forum, and he also talked about October inflation being below 7%, and that's a good news and should help equities and bonds rally. And hopefully, prices of tomatoes and other protein goods like chicken, egg, and mutton should not derail the trajectory of inflation. Prior to the CPI print, there was a left tail risk both in equities, bonds, and to some extent for a different reason in the dollar index. But look at what 2 days or 1 week have done to the markets. From left tail risk, the kind of gains we saw, things look much better now. With the Dow Jones probably is now only 7-8% below its all-time high. There have been a lot of bubbles historically, maybe in gold, sometimes in the Japanese equities, then the tech bubble of 2000. But the bubble in cryptocurrency, is the largest by any extent. The market cap for crypto had gone up to $3 trillion, and the recent correction has wiped off $2 trillion from this market. The best thing is $2 trillion of losses in the crypto market has not impacted other asset classes. The REITs and InvITs did not do very well last week. Lastly, currency and commodities. Gold and silver went up by more than 5%. That's because they are oversold, and weakening dollar and lower interest rates helped gold to rally big time. We expect it to rally some more. Crude oil corrected by 2%, and that's because again COVID cases are rising in China. So China reopening fully seems unlikely. And Indian currency appreciated by nearly 2%, highest in several years. And this is on the back of US dollar depreciating by more than 4% last week. Thank you for paying attention. Hope you guys have a great week ahead. See you again next week.